Greetings, friends, and welcome to the Financial Game 2026. As always, I have with me Jose Miguel Crespi, my ever-present partner in this endeavor, and we're going to talk, as always, about this chapter, which we will be sending to all participants from now on, religiously every month. Jose, how was your year? How did you spend New Year's Eve, Christmas? Now we're back at it, full steam ahead.
Basically starting a new season, let's call it that, a new year. We have great plans for our podcast this year to keep bringing in guests, informing and educating the people who follow us, whom we appreciate very much. We've gained followers on different platforms, and that's the mission. That's the mission of Financial Game Special Edition. So, starting now in January, we're kicking things off with 2 episodes. This will become the official newsletter of our company, and we'll be sharing it with Marceno Ferdinand. And well, we wrapped up the year. December was very interesting, Ferdinand, in the markets. There was volatility. It was a month with volatility in the markets overall, but on our end, portfolios managed at Mercado Valores. The stress-free equities portfolio closed out the year very well. Our main equity portfolio officially ended the year with a return of 27.51% for calendar year 25. Its comparison, its benchmark is the Standard & Poor's 500, which closed at 17.72 for 25. So you're talking about a good alpha, a solid difference, right? I attribute, Ferdinand, much of this outperformance to discipline. Discipline in selection, discipline in rebalancing, discipline in sector diversification. In those moments in 2025 when we saw sector rotations, we always had some position in the portfolio performing well. So that's the importance of maintaining that discipline. How tactical we were in March and April of last year when we raised cash, protected ourselves, and then entered at a good point. All these moves, the active management part was a big contributor to this. Growth portfolios that were not strictly 100% stress free also performed very well, surpassing the 20% they were targeting for the year. These are portfolios that combine the stress free approach with defined outcome ETFs. The definer with portfolios, absolute returns, to which we assign a weight of about 20% to these positions, helps us participate and maintain exposure when the market is rising. But at the same time, it reduces volatility and the downside capture ratio is much lower. When the market decides to turn, it participates much less. In fact, it has buffers that provide protection. So, in that sense, it also performed very well. The all market portfolio is one of our lines. It had a return of 10.5% for the year. Very good, well diversified. Gold helped a lot there for the most part. The gold position, the gold ETF in that portfolio.
Okay. And
So for this year, what do we foresee? During these first weeks of the year, Ferdinand and I, the team, we've been working a lot on our written outlook, our expectations, and we're looking at many of the analysts we follow. They create their reports and send them to various institutions and banks. And we've seen actually there's quite a strong consensus. I would say there's a clear consensus that the S&P 500, looking at it as a market-wide index, should have a good year, a positive 2024 to 2026. The vast majority have it between 9% and 12% positive in the price targets from US banks. Mike Wilson is one of the chief investment officers whose writing I most enjoy reading. Morgan Stanley. At Morgan Stanley, Michael Wilson has it at 12% with the Standard & Poor's closing out 2026 at a value of 7,800. And interestingly, I know you read, Ferdinand, the report by Larry Williams, whom our followers who have been listening to us for many years know that we follow as a forecaster, as someone who studies
different sources. He has over 50 years in the market, and he has lived through a ton of decades.
Well, interestingly, I hadn't shared this with you. Mike Wilson has. If you compare Larry's natural cycle analysis with Mike's forecast, they're almost identical.
Almost identical.
Almost identical. So if we focus on those two, right? And I share that view. They understand and foresee that at some point during the first half of the year. I don't want to, right? focus too much, and this is speculation. This is obviously a forecast. It's not set in stone, but yes, during the first half, if we look at the first half of the year, they're expecting a high degree of volatility. That's what they're seeing, with the possibility of a correction period between 10 and 20. We already know that by definition, reaching 20 is a bear market, but they're seeing that opportunity now. Keyword opportunity. Both agree that it would be or will be a good entry opportunity at that moment. It goes
in the deep.
It goes in the deep, and that should lay the foundation for a rally in the second half of the year and then end the year on a positive note. That's where they're going to do their analysis, more or less. And why? A lot of people ask me, and why is it understood that this will happen? A kind of correction. Well, look, I like to write about it, and in my writing, I use the analogy of the perfect storm. Yes. It's in the sense that there are many different warning signs, different storm clouds, using the weather analogy, that are supposed to come together at one point and create this kind of volatility. Let me explain. We have situations outside the United States, geopolitical situations, which we know cause volatility and movement in the market. We have a change at the Federal Reserve, in the president of the Federal Reserve.
In May. Elections.
We have midterm elections in November. If we go a bit more micro into valuations, we have quite a few premium multiples in terms of corporate earnings. Earnings expectations are quite high. Expectations are pretty elevated. So what that means is that any small disappointment, any bit of negative news could cause some kind of negative movement in stock prices. We have a president in the United States who I understand is going to be quite focused on the masses this year, on trying to ensure the party tries to win over voters this year for the midterm elections. So we know we're going to see him very active when it comes to social media posts, comments, and so on. By now, it's become customary to have that aspect with him. We started the year with the situation in Venezuela federally, where obviously we know that the United States got involved, stopped Maduro, and removed him from the country. Right now, they're in the process of deciding who will continue governing the country, how the regime will be dismantled, and how order will be maintained. So that's another situation. Today we're recording on a Friday. It's Friday, January 16th. Today the topics have been Greenland and Iran. So we have a lot of situations out there that's where my analogy of the perfect storm comes in. And when all of this comes together, we could have those negative periods. That's basically how I'm looking at the market. However, remember that just like what happened in 24, just like what happened in 25, those correction periods turn into opportunities. And what you need to do is stay vigilant and active.
How do you see it? Well, personally, I think my analysis is pretty simple. Valuations are high. I mean, it's not like it was a year ago when we were sitting at this same table talking at this time of year. And last year's valuations were worse than they are now. The PE ratio was almost at 25, 26. Now the PE ratio is close to 21. There are those who argue, and you can correct me if I'm wrong, that if we really look at forward earnings, which are expected profits, then the market isn't so bad. It's not that overvalued. But if I look at history and we look at the PE ratio, the ratio in plain terms is the price you pay for the corporation's earnings. The valuations of corporations are determined by the expectation of their earnings. And based on that, a multiple is applied. And that multiple has historically fluctuated between 12, which is an Armageddon market, basically a correction of 40-something%, to possibly 26 or 27, which is where it was last year. Now then, personally, I think you have a Fed that is, in my opinion, in a good position. Employment. Despite all the expectations and all the speculation there was with AI, employment has remained stable. Inflation, it's on its way. It's not at 2 like the Fed wants, but it's on its way. Energy, with all this geopolitical stuff, the price at $59 a barrel. That's going to go down. Therefore, the expectation for inflation is downward. Interest rates should remain stable or go down. Me, right? Not immediately. You have a market that is not highly overpriced. So I could see a single-digit DJ this year. I could see a single-digit DJ. I'm not as positive as Michael Wilson, right? And he has specific data. But from the ARI analysis, which I rely on a lot, I see that you have all the elements and the foundations to... Cyclically speaking, it's possible that the market could have some single digits now, but 2027 is a whole different story. That's a whole other ball game. And there's no doubt that in Larry Williams' analysis and report, there's always this caveat. He says, well, the cycles are shifting and the stars are starting to change already by the end of 2026. Looking into a crystal ball, we'll see what happens. But for now, I've had a positive year.
If we look at these images, because last year we were talking about high single digits, low double digits, and 2025 surprised us. It was surprising. It surprised a lot of people.
It was surprising.
Larry talks a bit about how
newly
emerging. We could have 4 consecutive years of very positive returns in the markets. Let's see. I'm with you. My expectation might be to see a double-digit return, but I don't see that 12%. Compared to how the market has behaved, I don't really see it as impossible, but we have to stay alert. Implementation recommendations we can give to our followers. Well, look, we are slightly reducing our exposure to technology prudently just a bit. We've had excellent returns in the technology sector, everything related to artificial intelligence, etc., which is great, and probably many analysts expect the bull market in that sector to continue. But prudently, it's good to reduce it a little. There are good positions in healthcare out there, a bit more stable. So it's going to be a year where I think, Ferdinand, what we've talked about,
yes,
the strategies of define Archimedial absolute return are going to make the difference.
Define a little bit, just to refresh people, what exactly are the strategies being designed in financial engineering at the market level?
Well, look, there are positions in the market through what are called ETFs, exchange traded funds, which allow you to participate in the performance of an index, of a given company or index, to share in its gains, and they protect you in that, on the downside or in market drops by a certain percentage. We call these caps and buffers. Typically, right now we're looking at positions that annually offer you caps averaging between 12 to 15% return on the upside with 15% downside protection. So really, as long as the market stays within those parameters, you'll have a positive return above zero and protection against drops between 0 and 15% negative. So they're very good. There are positions that have automatic rebalancing every 3 months. We're integrating them into portfolios. Instead of going for 12 months with buffers and caps, we can do it every 3 months, which is more short term, and we do a reset every 3 months, which is a bit more in line with active management.
No, and mainly these strategies are engineered in such a way that they're not an annuity, they're not an insurance company. This is financial engineering in the sense that an architectural design is created to provide protection based on contracts available in the secondary market, using the stock market, and maintaining liquidity. Very
important with liquidity. This will be a topic in upcoming episodes as we continue our discussions. We'll have Roberto as a guest, and we can talk, for example, with Robert, who has already been a guest on our show, about how to integrate this into a person's or a client's planning, and how we can combine this with other alternative investments that we'll also be discussing, because these holistic portfolios are very important for this new year and for probably the volatility we're going to experience.
Well, I think we're out of time. We'll be back next month for the next episode. I think we have an assignment and a commitment to expand on what's called the absolute return strategy, which I believe will become our main theme for 2026. So there's no more time left. See you next time. Until
next time.